Hello and welcome to CMC Markets Trading Outlook for the week of June the 8th, 2015. My name is Colin Szynski, Chief Market Strategist. We're coming off an unbelievably, hugely busy week for the stock markets, commodities, currencies, and treasury markets all around the world. We had a huge number of developments, tons of economic data, tons of OPEC meeting, huge non-farm payrolls and Canada jobs reports on Friday, Greece's decision to bundle its payments and hold off and bring everything have it all come together at the end of June. So the question we ask ourselves really is what do markets do for an encore into the new week with everything that's happened? And it's really, there actually still are a number of potentially significant developments this week that could move the market. It's not just going to be all about follow through. There are, but we do see the focus shift a little bit more towards Asia Pacific markets. So as we're heading out of the week, we've had the OPEC decision has come through, and they've basically decided to continue their supplier war and continue to maintain production levels. And this has had a mixed response from crude oil. I'll show the chart a little later on. We had, as I said, Greece put off their deadline with the IMF to bundle their payments, and now it all comes together to a head on June the 30th when their bailout program also ends. So we could see choppiness on that throughout the rest of the month. And the big thing we've seen coming out of this week was a huge 280,000 increase in U.S. non-farm payrolls, huge 59,000 increase in Canadian payrolls. We've got here on Friday the 5th, we've got U.S. dollar and Canadian dollar exploding higher against other currencies and pretty much even with each other. Now going into the new week, the focus really shifts more towards Asia Pacific markets. The week that ended really was primarily focused on Europe and North America. This week, coming week, it's Asia Pacific's turn. We start off with the monthly basket of Chinese economic numbers, and these could be particularly significant this time around because we've had such a huge run up in Chinese related markets over the last few months, and there have been signs that maybe they could be ready for a correction. So the data that we get out of China could be significant and have a particular impact on which way these markets could be headed. So we'll start off with the Hang Seng, the Hong Kong 43 here. As an example, we can see in March it absolutely exploded higher, but through about mid-April through now the last couple of months, it's kind of been going sideways here in a channel between about 26, say 940, 26,900, up to about 28,650. So a pretty wide channel here, but it has been coming off. We're seeing here the falling RSI momentum suggests the upward momentum is running out of gas, and we've got a double top in here now. We're starting to see a correction. If we did see it, we've got some long tails here. There was this one big candle, but the rest of them, the support here is around 27,250. We start seeing that, or 27 start getting taken out, and you could see a correction. On the other hand, if you did get stronger China data, could help to support these markets in their current ranges. If we look at the Hong Kong China H shares, which track the Shanghai market, we'll see similar action here, where we had seen them working their way higher, and then absolutely exploded at the beginning of April, and then for the last month or so they've been trading in a range between about 13,650 and let's call it about 14,850. One spike up to 15,000 that didn't last, which could be a throwover or a bull trap or an exam. It actually was a doji, so an example of how the bulls were dominating and then the bears came right back, and then look at this, a couple of days and then kaboom, we had this big bearish break to the downside. So now we're working our way back to the bottom end of this channel. The question now is, do we hold this channel? Do we start to break down? Well, if we come down here and look at the RSI, it's now broken under 50 to suggest momentum's turning downward. If we start to see this 50-day moving average get taken out here around 13,860, this could be in for a correction. The first support is down, channel support about 13.6, and then the top of this gap here around 13,000 even, and a round number. That so we could see if China data doesn't come through, the Hong Kong markets could be vulnerable here. The other significant thing we've got happening this week in the Asia Pacific region is the Reserve Bank of New Zealand is having an interest rate decision, and I'll bring up Kiwi dollar to show the significance of this. This could generate quite a bit of trading action, and the reason for that is that the Reserve Bank of New Zealand is in 2014 was probably one of the world's most hawkish central banks. It actually raised interest rates 4 times. Having done so, it now has a huge amount of scope to cut interest rates should it feel like. The New Zealand economic data has been mixed, and but certainly lots of other central banks have been cutting interest rates, including the Reserve Bank of Australia a little while back. Now, while the RBA looks like they're done, the RBNZ has certainly a lot of scope to cut rates should they feel like it. And what's most important about this is that for the last 6 weeks or so, these shares, the Kiwi dollar has been basically trending straight downward. And now it's down, getting pretty close to a test of the 70-cent level, and here it's just broken down to a new low, a new 52-week low. So what we're looking at here with Kiwi dollar is that it looks like the street is pricing in an interest rate cut, even though officially the consensus estimate is that they'll hold interest rates steady. So we're watching for the decision and the statement. In the statement, they've been talking down the dollar. Will they continue to do so now that it's down at about 70 cents? Also, will they cut interest rates? Will they hint at cutting interest rates? Will they commit to being neutral? Either whatever comes out of that could have a significant impact. But certainly, more dovish could keep the pressure on the Kiwi dollar. Anything that's not all out dovish you could actually see a bounce in the Kiwi dollar, considering how oversold it's gotten lately. I'm just going to show the Kiwi dollar against the Aussie dollar because it had gotten close to parity and was quite active at the time. We've seen, interestingly enough, you would think that sorry, I'm going to use the other one, Aussie Kiwi. There we are. There we go. So we have the Australian dollar, New Zealand dollar. What was interesting about this pair was back here, it had gotten very close to parity, and you had a double bottom, and since then you've had it rallying. You would think that in the last few months that it would have been the RBNZ cutting rates and not the RBA, the way that this pair has gone over the last couple of months. But in fact, it was the RBA who cut rates, and the RBNZ has yet to do so. So certainly there could be some pressure on them to start cutting rates. It looks as though, again, the street is certainly expecting it. Now, interestingly here, you had a triple top up here, you had a double bottom down here. So you now look like you're starting to get a double top here in and around 109.20. If they don't cut interest rates, if they even just hold steady, this pair could be ready for a turn downward. First support here, this Fibonacci level by 107.55, and then around 106 even. And also we look here, we see the RSI had gotten very overbought. Lower high in the RSI again suggests upward momentum slowing, just like we kind of had back here. Negative divergence back here, and then we leveled off and it started to roll down. Here we could be leveling off and potentially rolling down. Now, if they cut rates, it could stay the same or continue to climb. But certainly, it looks like the rate cut's already been priced in to Kiwi dollar markets. So that those pairs could be quite active in the new week around the RBNZ meeting. The other thing we do have in Asia Pacific is the Australian jobs report. Now, this will be particularly intriguing because now we're coming off of a week where we had some big payroll gains, not just in the United States, but also in Canada, where we've seen the lower Canadian dollar is starting to help other sectors of the economy. Even though we had the slowdown in the oil patch, manufacturing and some of the other export areas seem to be starting to benefit now from the lower dollar and are starting to pick up. So the question is could this be the same for Australia, where we've seen the Aussie dollar come down dramatically over the last several months as well? I mean, it was up above here, up back in September, up near 94 cents. It's now down at 75. So the question is, does this lower dollar, can this potentially help the Australian economy as well? Well, we're kind of leveling off here, but it has the Aussie dollar has come off lately. It's sitting on 76, more support near 75.50 or 75. If the Australian jobs report starts to pick up like we've seen in Canada, we could see a rebound in the Aussie dollar. If we get a weak report, Aussie dollar could remain under pressure. We're certainly seeing RSI holding below 50 does suggest that it is still under pressure here. Now, moving over to the other parts of the world, it's pretty quiet for pretty much everywhere else. It's like all kinds of news has come out, and now a lot of people are taking a break. So we could see some focus more on like the follow through from the last few days in world markets. the sorry, I'm just going to bring a chart back up here. There we go. And there. So what we're going to look at now is to shift over and take a look at U.S. markets for a minute. And what we're seeing here, we'll start with the Dow. We're seeing overall, we're continuing to be in this extended sideways consolidation for U.S. markets. Look, we've got a double top here, and we're seeing things retreat. Dow dropped under 18,000 on the strong payrolls report. The reason for that being is that increasingly now pushes up the timetable again for the U.S. interest rate liftoff. It is possible now that we could see it in July or September, whereas some of the weak data we'd seen more of the last few weeks had suggested, well, maybe it could be October or December. So we've shifted up the potential. So what does that do? That knocks stocks back a little bit. And what we're seeing with this sideways trend, and it's really important, is we're in what I call a mid-cycle consolidation. And this is something that takes place usually over a period of about 9 months to a year. We saw it in 94, 95, 04, and 05. We're seeing it again here in 14, 15. And what we've got is we've had a huge liquidity-fueled run-up in the stock market, and now things are leveling off. Why? Because the liquidity from the Fed is starting to dry up. The Fed's starting to talk about raising interest rates now, not just tapering, not just cutting back QE, but actually starting about normalizing interest rate policy. So that puts a little bit of a cap on the markets. On the other hand, what we have is we still have, though, the reason why the Fed's talking about raising interest rates is because, as we saw today, the U.S. economy is pretty strong. So the markets have trouble going up very far, but you really can't knock them back too far either, because eventually you get support from underlying valuations and earnings growth in the positive economy. But for now, we are seeing Fed speculation increase that's driven up the U.S. dollar, knocking back the stocks. So Dow's under 18,000 may continue to drift back. The one data point we have from the U.S. this week is retail sales. One of the areas that's been consistently lagging has been consumer and business spending. While we've had more or less positive employment reports through much of the last year, the durable goods orders, personal spending, retail sales have been dragging. So we'll be watching again to see, are we starting to get any kind of a pickup on that into the spring? If we do, could fuel the fire of interest rate hike speculation. If we don't, could throw a bucket of cold water on it. So depends on which way it goes here. I'll also show on that what we've seen today on the U.S. dollar index, absolutely exploding to the upside here on the renewed Fed speculation. Like this big candle here, so big hammer candle, bear trap. Looks as though the bears have been flushed out here. The bulls have come back in. We've also got. So we'll show you uptrend, correction, selling's been flushed out, hammer candle here. We've got a big move to the upside here and a turn up here above 50 for the RSI, suggesting we've probably got a higher low in place now here. This is starting to work higher. We've got about a week and a half now until the Fed meeting. It's not in the coming week. It's the week after, not the week of the 8th. It's in the week of the 15th. So there's lots of time for continued speculation on what the Fed might do or say at its next meeting. The other place we've seen the impact of the U.S. dollar rally has been on gold, which I'll also bring up here. Gold is starting to break down. We had it in a pretty solid channel here between 1170 and 1220, or up to 1230. This has been broken in a pretty major way. So if we move that to there, and if I bring up my drawing tools, and we'll show a support and resistance line here at 1170, tells us that we've got a pretty significant breakdown here. We've taken this out there, and we're continuing to show the RSI falling, which is telling us that downward pressure has been increasing here as well. So we're definitely seeing a downtrend for gold. You could retest this 1142 to 1150 area for gold. While we're at it, I'll take a look at crude oil here. Crude oil looks like it's starting to roll over. OPEC has kept the supplier war going, and why not? They're winning. So we've had a nice recovery here out of this, from the low 40s up into the low 60s. But look, each time we've tried to streak above the 60 level, it's been knocked back in fairly short order. 60 to 62, new resistance zone. Now we're starting to fall back off again. We're testing support and resistance here in and around, this is about 56.80, so in and around $57, we start to see this zone of congestion between, say, 56.50 and 57. If that fails to hold, then we could see a further correction back into the 54.50 to $55 area for crude oil. So at this point in time, there's less news. We'll still get a U.S. weekly inventory report that could generate some activity, but otherwise, it looks as though the big news on crude oil is probably past us now. But at the same time, it looks like this rally is kind of getting tired as well, and we could be into more of a sideways trend or even a downdraft as it tries to establish a new trading area. A couple of other things I just wanted to highlight briefly. I'll do U.S. dollar CAD. The Canada also had a really big report today, earnings jobs report, and we're not actually seeing it that much in dollar CAD. The U.S. dollar is up above everything else, but here it's kind of deceptive because we're still seeing it basically hang around $1.25. So it would seem as though there wasn't much of a reaction to the Canadian report. But if we come up here, and I'll just show these up here. Here's CAD against the euro, exploding higher. CAD against the yen, exploding higher. Look at that. That's a big breakout there for CAD yen out of an ascending triangle. So with the exception of against the US dollar, because it itself has been so strong, CAD has also been very strong. Even though it's a quieter week for Canadian data, we could see some continued momentum, at least early in the week, off of these kind of breakouts and the strength of the employment report, which means that the Bank of Canada is unlikely to cut interest rates again. There, it looks like they really are one and done on that. And just to wrap up here, I will show euro dollar and cable. In Europe this week, things might go a little bit quiet. Greece has kicked the can down to the end of the month, so there's a little bit of pressure off here. And meanwhile, we've got the U.S. of course rallying. So what have we got here? We had this shooting star candle. In fact, this now is looking like an evening star. Where we had, look at this, we had a big up day, a shooting star candle here, where it literally shot up and then was knocked right back. So either the bulls ran out of money, or else the bears started to regain strength. But that's a pretty huge rejection there above a 112.80 Fibonacci level. This was tested here as new resistance, and bang, down to the downside. This low here is lower than this low here, so this looks like a completed bearish evening star triangle candle pattern, and looks like we could see a correction. Well, to where? Well, this is about 111.11, and this next one here is about 110. Even 109.75 to 110, and this trend line here comes in about 109.60. So the 109 to 160 area is a possibility in a correction. I'll also take a quick look here at cable just to wrap up. There's so much going on; it's just incredible the way markets have been going of late. So let's just finish up with sterling. We may see more chatter around whether or not what kind of negotiations the British are going to try and do with the European Union. But considering how far Greece has gotten, it's hard to see. There doesn't seem to be a lot of appetite for change at this point in time. So what have we had here? Well, we've got the sterling basically after a huge downtrend. Does look like it's bottomed out here. It does have support coming in for it at a higher range in this 150, 160 to 152.20 kind of area. But the one thing to watch out for is this could be a head and shoulders top, and the RSI rolling under 50 here and staying below is also discouraging. If we saw 152 get broken again, next support in and around 150.65 or the 150 even level, this would be probably more predicated on the continued strengthening of the U.S. dollar than perhaps weakness in sterling. So we are coming, even though we're coming off probably one of the busiest weeks of the year for trading, we still do see a number of potentially things that could happen. There are a number of markets that could be impacted by the news that is coming, and there is still scope for trading opportunities out there.